Hello, everyone. Thank you for joining today's post-election market update webinar featuring Chad Staskal, Managing Partner of Eagle Wealth Management, and Robert Meckstroth, Senior Portfolio Manager of City National Rochdale. Today is Tuesday, November 12th, 2024. And now I'll turn it over to Chad.
Thanks, Jacqueline. And hey, thank you, Robert. So glad to have you joining us. I know you've got to be so busy with phone calls and helping out all of the clients out there with all the big news coming on with the election. I know on our end, we're staying real busy with tax planning here at year end. And obviously, we're going to get a lot of questions and have been getting a lot of questions here throughout this year of how the election is going to play out. We finally have some answers, at least on two of the three branches of the executive government. So I'm looking forward to hearing you go through and kind of talk about how City National Rochdale is looking at the election and the impacts that it's going to be playing on the markets and how you're setting up the clients for success. So I'm going to let you just take over. I know there's a lot to cover, and then we can just maybe touch base at the very end and go over any questions.
Sounds good, Chad. And thank you so much to everyone listening to this recording today. Like Chad said, a lot to cover. Put a brief agenda up on the screen here of what we'll cover today. I'll talk just a little bit first about the overall economic situation before getting into the impact of the election. And then we'll talk through the impact of the election, what it might mean for markets, economics, investment positioning. And then we'll finalize the conversation with just some thoughts on both bond and stock investing going forward. But to start, let's talk economy. Let's talk the speedometers, which many of you have seen before. And these are what they looked at like leading up to the election. So the economic story, very solid. President Trump is going to inherit a very strong economy as he comes into power next year. When we look at the U.S. economy, a couple of key trends that were playing out as we headed into the election. Most importantly, inflation, despite it being one of the number one concerns heading into the election, is actually now the most green of all indicators, which I think is telling. Doesn't mean prices have gone down. It just means the forward-looking outlook for inflation is a lot lower than it was 24 months ago. And that was a function of the Fed raising interest rates as much as they did. The Fed put interest rates over 5%. The goal was to get inflation down. That goal is looking successful. And what's also looking successful is the Fed may have pulled off the soft landing that not many saw coming. Consumer spending and corporate profit growth is still very strong. The labor market, even though there's some weakening that we'll talk about today, is holding up very well. And the Fed is now in position to lower interest rates. We had the Fed lower interest rates last week, another 0.25% on top of the 0.5% decrease we had back in September. So the Fed is going to continue to cut interest rates. We'll talk about maybe not quite as much given the result of the election. I'll talk about why that is in a minute. First off, these are our forecasts for year-end 2024, 2025 on a number of metrics. I'll start at the top with just economic growth and corporate profit growth. And these figures are unlikely to change that much, even with the result of the election. You have 1.5% to 2% 2025 growth for the U.S. economy and 10 to 14% corporate profit growth. I think the corporate profit growth is very telling. When you see it in earnings, we have double-digit earnings growth this year compared to last year, and we're probably going to see double-digit earnings growth again next year, barring major unforeseen changes. Companies are in very good situation, especially knowing that interest rates are coming down, inflation pressure is coming down, and probably going to be an administration that is more favorable to companies and the economy. There could be some downside with that we'll talk about, but there should be favorable conditions for U.S. companies ahead. And you see inflation, even though we're not projecting it to get down to the 2% level that the Fed targets, we're seeing lower levels of inflation than we've had over the last couple of years. Fed funds rate target. When you look at the Fed now, we think 4.25 to 4.75 by the end of the year. That's probably one more cut in December, that's likely, and then a couple more cuts next year. We've been a little higher than many market participants on our 2025 Fed number, but I suspect after the election, we're going to see a lot of market participants come closer to our number, given what might happen with economic growth and inflation ahead. A lot we'll find out. Now, the 10-year Treasury is very interesting because right now the 10-year Treasury has pushed well past 4.5%. And you'll see our 2025 year-end forecast is below where we're at now. So this is one of the Trump trades that we'll talk about, is that the bond market, long-term interest rates are under pressure because some of the potential policy moves may be either more inflationary or increase the overall national debt. And as the government has to finance that debt, we have to issue more treasuries. When we issue more treasuries, oftentimes the interest rates will go up if there's not enough buyers of that debt. So that is one thing the markets and us are going to watch very closely ahead, is what happens with this 10-year Treasury rate. Because investments like mortgages, those are going to be tied more to long-term interest rates than short-term interest rates. So many of you have probably seen this play out, that even though the Fed is cutting short-term interest rates, mortgage rates have actually gone up significantly over the last couple months. And that has put pressure on a lot of home building stocks. And that could be a while before we see relief on those long-term interest rates. So let's get into the election. This is just a chart of election volatility or market volatility. And you'll see in history since 92, as you get closer to the election, stock market volatility has been higher than average. And in the days after, you typically see higher volatility, at least for the first month or so, before it calms down. Now, remember, volatility works both ways. We're seeing a lot of the positive end of that volatility right now, with stocks ripping higher post-election. But we're probably going to see likely a few more days of volatility, especially as we get more concrete ideas of what some of the policy moves might be. And these are slides that we put together before the election. So I've highlighted the Trump scenario because now we do have that certainty. And where we sit today, it's looking almost a guarantee that the Republicans have full control of the House as well. So it's going to be a Republican trifecta, government control. But one thing we'll talk about today, the margin of Republican lead in the House is going to be very, very small. So it's not going to be easy to have comprehensive reforms, comprehensive policy changes, because it's just going to be a major challenge to get every Republican House member to be on the same page. We've seen that a lot over the last couple of years. Not easy to do. But what we're looking at is, Trump policies are likely to be more growth inducive. So GDP growth, you see, is actually the highest under the Trump scenario here. But look what that comes with. It also comes with potentially higher inflation. So we are going to, and you're seeing the market trade like this. Stocks are up, but bonds are down, really because this is being priced into markets. Right side of this page is debt to GDP. Notice that we are projecting a higher short-term government deficit under the Trump administration, because you're going to be looking at tax cuts. Tax cuts are going to lower revenue, and in the short run are not going to come with enough growth to offset those. Those are likely to be increasing the national debt. It also has potential to change after-tax income for different income ranges. So I've highlighted again the Trump scenarios, because if you are going to have potentially more tariffs and lower taxes, you're going to affect the income levels after tax for different income groups. So tariffs will hurt lower income individuals the most, and tax cuts will usually help the higher income brackets. So you'll notice here that wage gains are expected to be higher among the higher income brackets compared to the lower. And this will depend. A lot of these numbers we're going to go through are complete guesses based on the likely policy moves. Now, there are a bunch of levers that can be pulled. We don't know what's going to happen on the tariff side. You look at the tariff policies here on the right. These are what increases to effective interest rates may occur. You have a 10% tariff on all goods, 60% tariff on Chinese goods, 10% tariff on anything not covered by free trade agreements. We don't know if all of these levers are going to be pulled, but the more tariffs you put up, the higher interest rates are likely to go up, and the more damage that gets done to those lower income groups. You can see the tariffs are here in blue. The decrease in income, depending on associated with tariffs, it really hits the lower income individuals a lot harder than the highest. And then the tax cuts, we just talked about that before, that typically will help the higher earners. But again, we don't know exactly which levers are going to be pulled. Corporate taxes, we talked about, company profits likely to be, boosted a bit. You can see some of the Trump potential moves here on the tax side. Corporate taxes, we've seen proposals of dropping those down to 15%. Some talk about dropping the federal capital gains taxes down to 15%. We will see on those. And then immigration. Immigration is one of those levers that I talk about that we don't know what the full result is going to be, but it's pretty clear. If you lower your labor force by deporting individuals, you are going to have a negative economic move associated with that. Now, we don't know the extent of immigration policy. We don't know exactly how it's going to play out, but a couple of scenarios here. Obviously, we don't see this, $21 million or 21 million individual deportation plan actually going through, but we just put it in there to show how much economic damage would be done if you remove 21 million people from the country. Much more likely that we see, something like the first scenario where you're chopping off 1% at most to GDP. But it will be interesting to see how this administration, goes forward, because this has actually been one of the reasons the U.S. economy has outperformed many others, because we've been able to grow our labor force. Whether that's good policy or bad, that's not my opinion to make, but it certainly, immigration has had a positive effect in the short run on U.S. economic output. So we talked through a lot of policy stuff. Here are the four kind of levers we talked about: lower taxes, higher tariffs, lower immigration. We all know there's going to be some combination of those in place, but we don't know the extent of how much in each one of those categories. But you see the economic impact of each of these that we talked about. Lower taxes helps. You lower taxes, you're going to increase economic growth, and you're going to increase corporate profits. I mean, that is loose fiscal policy that helps. But you're going to increase the national debt, and you're going to, all else equal, cause higher inflation and higher interest rates. So this is why the Fed rate cut projections are lower under Trump so far, because investors, not just us, are factoring in slightly higher interest rates and slightly more inflation, given the fact that we think the federal deficit is going to be likely higher and tax rates are likely to be lower. But that also is likely to result in higher corporate profits and higher GDP. So the market is going to be trading, I'd say, a little more volatile, because especially as we get in the first 100 days of the administration, as we figure out how much we're going to see these policies go through. And you see the immigration one as well, because the immigration kind of offsets some of that. You lower immigration, that's going to hurt economic growth. That, could be deflationary in nature, and it's certainly going to hurt corporate profits if you lower the labor force. So we'll see how that plays out. I think at the end of the day, the extreme scenarios in all of these categories are probably the least likely. It's more of somewhere in the middle from the extreme projections that have been thrown out. It's kind of where we lay things out for now, but we'll be watching it closely. Now, final comments on the election. There are definitely some sector trades that are playing out. In the Democrat side, you've seen some pressure on healthcare stocks, utilities. Some select industrials have pulled back a little bit post-election. Throw the home builders in there. Home building stocks have been hit pretty hard because not only were some of Harris's policies potentially favorable for home purchases, but it's more because the mortgage rate's going up. So home building stocks have not been good. And then the Republican trades outside of Tesla and the Elon trade, you have financials, banks, insurance companies, places where you see potential loosening of regulatory standards. That's going to be a key theme and key thing to watch is how do regulatory standards get loosened, and does that mean more profit opportunities for certain sectors? We'll be watching those themes closely and potentially taking action where needed in client portfolios. One of those areas we probably will not be buying is commodities or gold. Gold prices have surged higher over the last couple of years. You see this chart here, gold with the golden line there at the right, up almost 30% year to date. Gold is sold off after the election. So some of the worries about not knowing what the result of the election was going to be, some of the potential chaos associated with the election, I think those worries have gone away for now, and you're seeing gold prices come down. And gold also is not going to do as well when the dollar is surging. Right now, you see a surge in the dollar post-election. So this gold trade might be ending as far as that huge rally. But gold has been one of the only commodities to really surge. Everything else has actually dramatically underperformed stocks. So we don't see gold as a place to go right now just due to the speculative nature of it. China, getting questions on China because China is putting a lot of money into their economy, a lot of stimulus. It's kind of the opposite of what's going on in the US, but it has not worked out well for Chinese stocks. One of our best decisions has been to avoid Chinese stocks and avoid international stocks in a lot of ways. So this shows just year-to-date performance compared to the US, Europe versus the S&P, emerging markets versus the S&P, China versus the S&P. US has outperformed all of these. Even after Chinese stocks got this 15% lead with all the stimulus, they pulled back in a hurry. I think the election result, just given the policy discussions of the Trump administration, not an exciting time, from my perspective, to try to jump back into Europe or Asia. It seems really that a U.S. focused investment strategy is still the way to go. So, kind of in conclusion, look at the Trump key takeaways here. We talked about the 4 different levers: taxes, tariffs, debt, and immigration. Those are going to be the things to watch. How much of each of those do we see, and what is the underlying effect going to be on the whole economy? We'll be watching that daily. You'll see those changes show up in the speedometers as needed. And then the official kind of sector policy changes: financials, energy stocks, sectors that will benefit from less regulation. We will see. It's unclear on the tech side. A lot of the tech risk is in potential for antitrust issues with Apple and Microsoft and Google, Facebook. It's not clear whether the Trump administration is going to be more favorable for the tech sector. The Biden administration had been pretty aggressive at looking at some of these companies, so we will see. That's something to watch very closely, but it's likely to be a more robust environment for mergers and acquisitions as we go. But we don't know a lot, so This is our best guess a few days after the election, but a lot we're going to find out in the first 100 days. So with all that said, let's just take a deeper look into the economy. When we look at how the US is doing, pretty darn impressive economy, all things considered. The envy of the developed world has been thrown out a lot because this shows US GDP since 2017. And you see, despite the COVID dip, we're off to the races. And the darker blue line is actually the revised economic data. There was just a major revision to data that showed the US economy has actually grown a lot faster than previously thought. And the dotted blue line there to the right, what is the trend line for our growth over the last 10 years? And despite COVID and that major dip there, we're back above trend on the US economic growth. I mean, this is something that any European economy would love right now, and they're not seeing the same stuff. And then, the US consumer is obviously so important for our economy. If we look at disposable income, look at the revision to disposable income here on the left. Significantly more income for Americans than we actually thought with our previous data. And that means a higher savings rate than we thought. This is very bullish data because one of the ways our economy can grow is people saving less. So if interest rates get cut, all else equal, that's going to support more spending over savings. And it just shows that our savings rate actually has room to go down even more. We are not a savings-based economy. We are a consumption-based economy. So when we have room to spend more, that is all else equal bullish for the US. And this is one of my favorite charts that we put out is, plans to take a foreign vacation in the next 6 months. I think this is just, like we talk about in the first bullet point, the ultimate in discretionary spending. If you're going to pull back on one thing, this is probably the first thing you pull back on. But look at the difference in this chart compared to the last 20 years. People are still very comfortable with their financial situation, saying they're going to travel internationally in the next 6 months. 20% of the population. Economic surprise index is just every one of these economic releases from labor to manufacturing. We're getting a lot more beats in recent times than misses on this economic data. That's consistent with what we're seeing in the data. This is in some ways a measure of the speedometers in a lot of ways, where if a lot of the data is good, it's likely to show as positive in the speedometers, and we're seeing a lot of that. And then we talked about this a little bit. This is complicated charts, but I like the one on the right a little bit. It shows, all else equal, is the monetary policy, fiscal policy, everything together, creating easier or tighter economic conditions. And what both of these charts show is, even though policy was getting tight for a while there with interest rate cuts, it's loosening again. And that has very big implications for the economy. So all this talk about the election, all this talk about potential policy moves and actions, the very act of the Fed cutting interest rates may be a more powerful force than anything that we're talking about post-election. And this is small business data here. Uncertainty on small businesses before the election. I think this is one of the positive takeaways post-election is that when we see these small business uncertainty numbers, we're going to see these come down. Most important problem being inflation. This wasn't just businesses. I think this was all of America in a lot of ways. And we talked about inflation already coming down a bit. We're probably going to see improvement in some of these charts. So when small businesses are less uncertain or more certain, and they're not worried about inflation and borrowing costs comes down, this is a big positive for small and medium-sized companies. And it's one of the things on our investment radar to start looking more at these medium-sized companies, depending on someone's risk profile and objective, given a more positive outlook there. So last part about the economy, and we'll get into a couple of the investment categories. This is the unemployment data we have in this presentation. I mentioned it before, the labor market is starting to cool a little bit. Even though unemployment is still low, check out these charts. The left side is hiring plans and wage gains. The light blue line on hiring plans, you can see how that has come down dramatically from the top. At the same time, wages going down as well. So on the right, we have a little bit more data on whether it's job switchers or job stayers, or on average, wage growth is down across the board. We don't have the quit rate on this chart, but as you see the job switcher wage gains go down, a lot of job stayers are staying with their current employers. You're not seeing as many people quit their jobs. It's definitely a sign of the weaker labor market. The Fed sees and uses all this data. In fact, this is Atlanta Fed data. One of the key reasons the Fed is comfortable cutting interest rates is we're seeing some of this labor market weakness. So we talked about this. The Fed cutting interest rates are going to reduce borrowing costs. They're going to potentially reignite the economy a little bit, despite the slowing GDP numbers, and it should make more room for continued growth in equities and bonds. And I see, Chad, you're back on the video here to chime in.
Yeah. Hey, Robert, thank you. I really appreciate it. I know the people watching, it's always good to get some different opinions on kind of where we're at. And I think what you're going through is a great another great example of that. It's a lot of times the economy that dictates the elections much more than the election that dictates the economy. And I think a lot of your slides really pointed to that. One of the questions I know, I'm assuming we're getting quite a bit, is that there's a lot with this kind of quick rise on the market and the risk on trades, is we're kind of back into having people asking about the cryptocurrencies and some of that level, because obviously Trump he started his own cryptocurrency, and he's obviously now become a big advocate for it. What's your thoughts on that, or how is CNR taking that thought process?
Anytime Bitcoin hits the all-time highs, usually the questions come in, and that's exactly what's happening. And that was one of the Trump trades. When Trump's odds went up, that boosted cryptocurrencies, because he's talked much more pro crypto than Harris did and the Biden administration did. Now, that said, cryptocurrency has not really changed in our view, in that it's a very speculative investment. It's going to have wild swings like we're seeing this week. We're seeing wild positive swings. When we get negative market cycles, it's almost certainly going to go the other way, where Bitcoin will swing in a very strong way to the downside during trickier conditions. So I think it is fine to speculate on it, but we think of it as only a speculative investment right now. And it's going to be highly correlated with what's going on in the stock market based on everything we've seen over the last 5 years. So a lot of times when I hear people wanting to invest in cryptocurrencies, they say, hey, I want it for an inflation hedge. Well, it was down big in 2022 when inflation went up. Or they say, I want it to diversify, so I own stuff other than stocks. Well, if you're buying something that's very correlated to the stock market, you're not getting the diversification benefit you think. So if you're buying it to speculate and gamble, then maybe it's a good investment for you. But for us, we're typically going to avoid speculative categories. And why I brought up this slide, Chad, is you also can look at the overall stock market back at record highs and ask the same question. Do you want to invest in stocks when they've hit all-time highs, or is it time to look other places? Even though the stock market's at all-time highs, every sector is not the same. And what we looked at here is the price earnings ratio of not only the whole market, S&P 500, but a number of sectors within the market. So even though the S&P is trading at almost a 22 times earnings, which is very expensive historically, if you go down the list and look at materials and industrials and healthcare, financials and energy, and we just talked about financials and energy, potentially being, good sectors post-election, those sectors are very cheap relative to the broad market. And you see that also if you look, like, exclude the tech sector, which is up at 30 times price earnings here, and the market does not look as expensive, even close. So when we invest portfolios at a time when valuations are this rich, not only do we want diversification across companies, but we want diversification across valuations, because a lot is baked, each sector is different. The tech sector is going to, be massively impacted if these companies do not deliver earnings growth from all this AI and new technology. But financials and energy, they don't need massive earnings growth for those investments to be successful when they're paying you a 3, 4, 5% dividend. So it's something that's top of mind, not only, avoiding some of the speculative categories, but just thinking about valuations and profits when we go through every investment we make.
No, thank you on that. I know we have this conversation with a lot of people, and when we're planning for all of the long term, I like to think of it more like pension management, is providing that retirement income through life. And when we're talking a lot of the different options like cryptocurrencies, well, hey, if that's something that somebody wants to do, it's but it's a speculation. It is so highly correlated. It's a supercharge. On the upsides, it does really well. And on the downside, it also does really poorly. So, and most people don't want to see that in their retirement accounts. Kind of looking at this, and obviously with the elections, and how are you guys looking at it with regards to globally? With the developed international markets as well as emerging markets compared to the U.S.
Yeah, I mean, we hit on it briefly with the performance just year to date, and that U.S. stocks have dramatically outperformed the developed markets and the emerging markets this year. And even China, despite all the stimulus, U.S. stocks have still come out ahead. But bottom line, I think, we would have probably felt that way no matter what happened with the election. But given, the success of the Republicans and all of the rhetoric, the America First rhetoric, the talk about tariffs, it doesn't make you too excited to jump into, international investments right now. I mean, I think, again, it was the case before the election. What gets you excited to go invest in Germany, which is an export-driven economy, at a time when, you might have higher tariffs and you have a weakening China? Because, an economy like Germany, just look at Mercedes-Benz and BMW as great companies that show the challenge that these European economies face. You have one of your best markets was China, selling Mercedes to, rising incomes in China. And now you're seeing a massive earnings deterioration due to the rise of the Chinese EVs. And, it is a massive challenge when one of your biggest markets now has competition that is so much cheaper, and the technology is just getting better and better. So, we haven't seen a bunch of these Chinese EVs, hit the US at all because of the tariffs. And I think you'll see, not only in the US, you'll probably see, even some of the European countries start to bring up tariffs more aggressively to fight off, things like, cheap Chinese EVs that are, pretty darn good vehicles, given the cost of them. So it'll be interesting to see how it plays out. But our, again, preferred strategy is just focusing on the US. And, it could lead to, really an evaluation of every company that you invest in, because depending on how the tariff situation plays out, if you're a business that does a lot of importing of, anything really, even if it's inputs for your domestic manufacturing, if you're bringing in stuff overseas that are subject to tariffs, that's going to increase your cost structure and potentially make your business less competitive, less profitable. So we have to look not only at avoiding international companies, but we have to look closely at every, even US company we invest in, just to make sure the math still works.
Yeah. And then kind of taking it into the US, how do you feel as far as where City National Rochdale is kind of looking? We've obviously focused a lot more on the large size of companies, but going down into those medium-sized and small-sized companies.
Yeah, I mean, that's the that's been one of the trades that took off. I mean, the small and medium-sized companies have been really, they've dramatically underperformed big companies for the last 5 years. It's been a very rough environment for small companies. Higher inflation, higher borrowing costs, tough to find labor. Everything was working against small and medium-sized companies the last 5, 6 years, especially with COVID. And some of that is now unwinding, kind of unrelated to the election. Just, if inflation is coming down, if interest rates are coming down, if the labor market is softening, all of those tend to help small and medium-sized businesses. But if you throw in a couple of the potential Trump administration policies, you're looking at maybe even more favorable conditions to smaller companies, because those companies typically are more domestic focused. So I know our research team's putting in a lot of work at, again, what is the best place to be post-election? I think we've got a very strong positioning now, but I do think there are going to be some changes, especially as we get more certainty on the policy actions. That's the difficult position, because a lot of what we talked about today is, hey, we know the levers that are going to be pulled. We just don't know how much each one of those levers is going to be pulled, because that's ultimately going to give you, the knowledge to make these positioning tweaks.
Thank you. Well, I think if you wanted to sum it up, I think, or if I'm kind of what I'm hearing from you is, while the election has definitely controlled the major media cycles, and it still is, as we're hearing some of the different choices for the cabinets and leadership of Trump's team that he's going to try and put together. I think what you're kind of going back, and what we try and focus on when we're talking about the financial planning and then going in now to the investments is we're watching a lot of the different moving factors, understanding that one factor, who is the president, or one tax change, there's a lot of other moving factors that come when we're looking at the investments to provide that income for the clients.
Yep. I think that's a great way to sum it up. And I always like to just go back to that first chart we looked at here of just, what is the next year looking like, regardless of the election. Is like, you're telling me the economy is going to grow and be positive. Companies are going to make, 10 to 14% in earnings growth. And these numbers that we put out on both of these, I'd say, are pretty conservative relative to a lot of what we see out there. So there's a solid floor, which is positive on both economic growth and corporate profit growth, that makes you feel real comfortable despite a lot of uncertainty in the world that's out there. So, and the fact that the Fed is cutting interest rates, the old saying goes, don't fight the Fed. When the Fed is adding some fuel to the fire, that is a big positive for markets in general. And, even though they're cutting interest rates are still, a lot higher than they used to be. So for clients that we work with that are in retirement, that are not all invested in stocks, we're now just able to sit back in a lot of our bonds and collect higher interest rates without needing to take on full stock market risk. So, for bond investors, we've talked a lot about equities and economics on this call. For bond investors, there's some real nice sweet spots where you can lock in some of these higher interest rates than we've had before, but you don't have to extend out your maturities so far that you're at risk of some of the inflation and federal debt and some of these, worries on the Trump policies. If you keep your bonds short enough, your bonds are going to be maturing where you cut some of that interest rate out there. So I think it's exciting times for both stock and bond investors right now, even though we're in a very uncertain period globally.
Yeah. Well, I think the uncertainty is the one consistent we get no matter what type of market we're in. So it keeps all of us with some job security. Hey, Robert, thank you again for taking the time to go through this presentation. And obviously we're recording this to be able to share it with all of our clients that want to take the time to watch it. So I hope you have a very successful day and make some good decisions for all the clients. And we'll be talking to you again soon.
Sounds good. Always a pleasure. Thanks, everybody.
Thank you.